everyone. Welcome back. We are here again with Dave Herbst answering and talking through the all-in-one loan. Again, something we're both really passionate about. Kind of wanted just to take a little bit deeper dive, Dave, at some questions that we get asked, and are they the right questions to be asking? So the first one being, rates are amazing right now historically. Why is the interest rate question the wrong question to be asking?
I love the way you phrase that, and thank you for having me again, Tana. It is the wrong question to be asking. I don't blame people for asking it, though. As you know, people are pretty programmed to really be, I think, primarily concerned or focused almost exclusively on interest rate. The real issue isn't the interest rate that comes with loans. The real issue is the amount of interest that people pay on their loans, right? And so it really comes down to a matter of importance and what really matters. What's hitting your household wallet? Is it this fictitious number or this number that just printed that you've locked in and is printed on your mortgage statements that equals, a certain amount of total interest that you're going to pay over the next 3 decades of your life? Or is it that number that equals the total interest you're actually going to pay? That matters most for the people that I speak with. If you've got an opportunity to reduce the size of that interest expense, that commitment to interest costs, it's hard to do in a traditional mortgage. And so I don't blame people for focusing on interest rate, because on a traditional mortgage, it's really the only lever that they can pull, for lack of a better way to describe it. We redesign the mortgage into what we call the all-in-one loan, is that you don't have to depend on interest rate in order to save you interest cost, given the way the loan works. It's about reducing your interest expense, being less dependent on your interest rate. So you kind of snap that cycle, the endless cycle of refinancing and depending on a new mortgage with a different interest rate or a lower interest rate to save you money, but rather just simply use the product as it's intended, which is a combination of a personal banking account and your mortgage all wrapped into one, and let your money go further for you to reduce your costs.
It's taking that mortgage advice from just remortgaging due to a favorable environment or a need, and almost re-engineering that so that you have control before you need it, right? A lot of what's attractive about a line of credit, in my mind, is it's better to have it and not need it than need it and not have it. And similarly, if I'm in a situation where I need to access my equity, I don't want the bank telling me I qualify or not, right? I'd rather set it and forget it, as we say. Let's talk about advice. I work with a lot of investment advisors, fiduciaries, CPAs, life insurance planners. Why are those folks coming around to learning about this program?
Well, first and foremost, I don't think that our industry, to be honest with you, has done a very good job of creating a high amount of value to fiduciaries, investment advisors, CPAs, tax planners, insurance planners, folks that are holistic in what they do, and they're trained, licensed professionals that really look holistically, as you put it, at both sides of the personal household balance sheet, both their assets and also your liabilities. I don't think that the mortgage industry has really created a lot of new value or high value to help in the effort that fiduciaries put forth to aid their clients. I think a traditional mortgage is part of the problem that the fiduciary has in their way as they're trying to help their customers, protect themselves and grow their wealth. I think the primary reason why this loan garners a lot of attention from that sector is because it's truly the only mortgage designed to put the customer first before the bank, before the lender. And it's fully designed to cut the interest expense, upwards of 50%, compared to a traditional mortgage. It gets people out of debt 2 to 4 times faster without any budgetary change. 100% of a financial advisor's customers utilize a traditional checking account to manage their income with. They're flowing their income through, their disposable income through that checking account. And from there, they're paying their bills. Any extra residual cash they're tucking away in a savings account or money market or CD, and maybe even towards an IRA or something, right? The cash that's utilized to pay for your regular bills and expenses is underutilized. It's not being utilized by anybody except for the bank that you have those funds on deposit with. And what this loan product does is it puts those dollars to work while it still gives you that transactional access. You can still pay your bills because this consolidates your checking account with your mortgage. That's a portion, I think, or a segment of the loan that fiduciaries really love, because they know that, their client's cash should be able to go further. In a traditional checking account, it doesn't go anywhere. It sits there earning very little interest at all. It's losing value technically as cash sits idle. So these are their dollars are put to work in the all-in-one loan before they need to pay their bills and expenses, which in effect saves them mortgage interest cost at the rate of their loan. So I think all of that, it speaks highly to what they do on a routine basis in an effort to shrink the cost of somebody's housing debt, which gets their clients ahead sooner. Like you said, it's good for the consumer, but the reason why it's also good for the lender is because you're going to stay in that loan longer, right? You're not going to go to that behavioral pattern of every 3 to 5 years refinancing, restarting the clock, committing to 15-year payment, and then being hosed if that payment isn't achievable. I mean, we're asked all the time, Tana, this, that, why would a lender do this? Why would a lender kind of usher forward a new type of program that saves, us borrowers interest cost? I mean, isn't that why lenders are lenders and banks are banks, to kind of earn interest and kind of leverage money? Yes, of course. But, the other kind of part of lending that it really isn't spoken about much or exposed much to the public is that it's also high risk, right? There's money being lent and there's exposure. There's also a lot of attrition, or what we call runoff. Historically speaking, the 30-year fixed customer refinances or pays off their loan either through a refinance or the sale of their home about every 5 years. Even though we've made a 30-year financial product for somebody, we're bound to lose that customer within about 5 to 7 years. The all-in-one loan has proven to be very different. It's really the last loan somebody would ever need on that property. And so it creates a stickier, longer-term relationship, and all the meanwhile accelerating their financial goals and their housing goals by paying less interest. I kind of want to talk about cash buyers too. We've seen a lot of that just in terms of the need for offers to get accepted. And we do a lot of these as a refinance, as a post-closing option for those that want a line of credit, that don't want their cash to be exposed or gone. Why should, folks who wouldn't traditionally get a loan, or realtors or investors, know about this product? I'm sure you're seeing in your market a lot of cash buyers still. I know that's prevalent out here in California, as well as other parts of the United States. One of the greatest things about this loan product for purchasing a new home is the fact that you can utilize what's called delayed financing. A lot of people don't want to commit that cash, but also want to win the contract, win the home. And so they put their cash out there, maybe liquidate some assets in order to make that cash purchase, possible, and get that home. So you can utilize this product, the all-in-one, for what's called delayed financing. The day after that purchase is closed, that customer can take a loan application out for the all-in-one loan, and we could provide them the majority of the cash that they put down and use to purchase that home. We could have them cash that back out so they could go utilize those funds back into an investment vehicle or wherever they had those dollars. So in other words, get a loan that's delayed after the purchase is closed back up to typically 80% of the value of the property, or the purchase price of the property. So, and that's an extraordinary, benefit of the loan. There's no seasoning requirement. Typically loans have a 6-month seasoning requirement in order to retain some of that cash out. This has no seasoning requirement for that purpose. You mentioned real estate professionals or real estate investors as well. Let me touch on both those. For the real estate investors, this is a phenomenal product. Because what I want your audience to understand is that the monthly payment on this loan, the minimum monthly payment on this loan is the interest, just the interest. It's the cumulative daily interest that totals up once the month ends. That becomes the interest due for that month. And it's actually not paid for until the 21st of the new month. Right. And that's an automatic debit from the all-in-one loan line of credit. The more you use this tool, the less and less interest that'll accumulate each month. So in other words, as you use this loan, your payment reduces automatically until it reaches zero faster. Think about that. You get a fixed rate mortgage, a traditional fixed rate mortgage, your payment doesn't move at all. On this loan, it reduces automatically. So for the real estate investor, your payment is reducing and you're actually growing your cash flow in that real estate, in the investment property, without having to refinance and without having to increase rents, right? And that's hard to do too. You don't want to scare away a really good renter, somebody that's loyal and paying on time. You can't price yourself out just because you want to grow your cash flow. So this does it for you without having to rely on those two things, which is an enormous benefit for real estate investors. For realtors, Tana, here's something that's, pretty unique. I always let the partners that I work with and that I've met and helped over the years, real estate professionals have the same issue as everybody else. They're trying to garner new business and close more homes, right? And create more value to their clients. We know that most of us have to borrow money in order to buy real estate. We also know that about 20% of the real estate market considers another property about every 5 years. The biggest barrier to realizing your housing goals as a borrower, as a consumer, is the cost associated with housing. So if you have a mortgage product that reduces the costs of housing substantially as a consumer, you're in a better spot to buy again sooner, buy up to the neighborhood you actually want to live in, or into the school district that your kids really want to be in. You can accelerate that process. So as a real estate professional, this is a tool to be able to start new conversations and help your clients accelerate those goals to buy again sooner and pay less for their financed real estate.
Yeah. And just like our personal experience, the realtors who have actually gotten this loan for themselves has been just incredible for their own, investment tool and everything else. Some
of our best testimonials are from real estate agents that, didn't really dive too deeply into mortgages and the structure of mortgages. And those people who now have the all-in-one just understand the power of it. And that's all they really want to talk about with their new buyers. And even their clients that are sellers, to be able to promote having access to a program for any potential buyer that walks into that, that property, considering that property, creates an opportunity for that real estate agent.
Yeah, and it's not just for the wealthiest. It's for the savvy, right? It's someone who has a bit of a innate discipline, but likes the built-in discipline. And how do we, realistically, even through underwriting, know that it's right for someone? Let's just touch on that.
Great question. It's suitability, for this product is critical, right? As it is with any financial tool that we're putting in place. Those that have some discipline, that are cash flow positive, that aren't living paycheck to paycheck. I would argue that those folks, might not be ready to be homeowners anyway, right? Might struggle to qualify for even a traditional mortgage, but especially for the all-in-one, to really maximize the time value of your cash, I should say. Somebody with some discipline, doesn't overspend routinely, lives within their means, is goal oriented and knows how to strive towards those goals financially. What makes this loan so appealing to that person and that household is that it's all visible. It's gratifying for those people. They almost make it like a game, because you see your mortgage balance reducing so quickly. You now see this tangible benefit of keeping more and more cash in this tool to help reduce your mortgage interest expense. But to test suitability and benefit up front, not only, do we go through the underwriting process, and this is manually underwritten, so we can think outside of the box and really kind of, tailor our decisions based on, each specific scenario. Right. But more importantly, we also developed what's called the interactive comparison simulator. This is a tool that's available online, and it can actually be found at allinOneLoan.com. It's a comparison tool. So it compares a traditional loan that you may have or you're considering getting to the all-in-one, but it goes further. It takes in consideration your banking behavior, fully displays all the different interest rate options and rate environment assumptions. So you could really play around with it and use it to forecast, and it'll tell you whether or not this is beneficial or not. So it's a critical step in making sure that this is a good fit for the borrower.
Yeah, right. We always want to run the numbers no matter what tool or mortgage you're considering. But this just has, way more inputs, right? It's not just the interest rate. It's not just the balance. It's behavior.
It's cash flow.
Exactly. Yeah. It really makes you look at, where you're at and where you're looking ahead. And it forces you to ask some of those questions that we should be asking.
Right. What if we just decided not to blow $50 a month like we do now? What if we just kind of cut back on that? How would that impact our interest expense and our payoff timing? You could run the simulator to figure those things out. What if we didn't remodel this year, but instead we did it next year? What kind of progress could we make? So it's a forecasting tool that really gives you all the math. And that's what matters. People should be making, their financial decisions based on the math, the logic, as well as the risk, and instead of emotion. Right. And so this really helps people test drive all those things, all those different variables in just a matter of moments. It's very easy to use.
And it's math, right? It's not magic. So I think let's just give everybody an invitation. If you want to run the simulator, I'd be happy to run those numbers with you. You could even run your own numbers and send me the key code, and we can look at what assumptions you put in. The simulator can be found at www.aioloan.net, and I would be happy to meet with you personally to look at that. So Dave, thanks again. Let's have you out in person just as soon as we can.
Yeah, I would enjoy it. Let's plan on that. And thank you for having me. And I'm willing to do as many of these as you'd like to. So I appreciate it, Tana.
Yeah. Have a great day.
You too.